All right, hello everybody. Hopefully this works. We had a little bit of technical issues before, but I don't think it's on me. I think it's something to do with YouTube because I know people have been trying to contact me on YouTube. But anyway, hopefully they'll fix it. So, in anyway, number two, I have been reading Willie Nelson's biography. Now, Willie Nelson, no, I should say Willie Nelson's autobiography. Willie Nelson, as we all know, is a genius songwriter, blah blah blah. But what kind of struck me was he said that like every song should tell a story, and I think every day in the market is a new story. So that's what I'm going to talk about. All right, a long, long time ago. In a galaxy far, far away. Actually, no, that's Star Wars. That story's already been taken. I want to talk about how the market is going to be going down, or I think the market's going to be going down, and about how you just shouldn't listen to the media. And, I talk about this all the time, and people are like, oh, Mark, blah, blah, blah. You're always like complaining about the media, blah, blah, blah. But these same people are like, dude, how do you get your call so right? How do you have such a great market call? And my answer is, I don't have a great market call. I let you know what the market is doing. The market calls itself. I'm not smart enough to figure out what the market is doing. Now, for example, I was talking about how we were due for kind of a sell-off when we got up to around here. Why did the S&P kind of stall out right when it got up to around 460? Well, it was a peak back here in April of 22, so over a year ago. A lot of times when markets get to a level that was resistance, they tend to run, or levels that were peaks, tend to run in resistance. How does that happen? Well, there are people that bought back here who regretted doing so once the market fell lower. And they tell themselves, damn, I made a mistake. I'm going to get out of this if I can at break even. So when the shares come back to their price level, you get these remorseful buyers placing sell orders. And if there's enough of them, what was resistance before becomes resistance again. Markets run into, there's no guarantee, but markets tend to run into resistance at levels that were former tops. That's why market psychology. It's not because of the debt ceiling or the Fitch downgrade. This whole Fitch downgrade is just such a stupid thing, and it's just so typical of Wall Street. All we've heard about is like, oh, sell off because of Fitch downgrade this, Fitch downgrade that. Let me tell you something. As someone who was in the institutional trading world for 2 decades, 2.5 decades, I don't like to talk about it because it dates myself. I can tell you with 100% confidence that people do not sit around saying, oh, Fitch downgraded the US market. Oh, let's go out and sell. It's irrelevant. It's nothing. It's not a big deal. Most of the time, we have moves because of psychology, like I just explained. We got up to this level that was a peak. Now we got remorseful buyers trying to get out. All right. Another thing we should look at, and if you follow me, I've been talking about this, and this is why I think the market's going to continue to go lower. It's because we've had this really bullish sentiment. This is a website we look at here at stockmarketshopper.com. It's a free website, really cool website, AAII.com, American Association of Individual Investors. They ask their members, which I'm not one, but they ask their members, are you a bullish, bearish, or neutral? Okay, and we could see that right here. Look at this. We got to 51% bullish on July 19th. We're at 49% bullish as of last week. That's a really high number. Over the last 30 years, we've only got up to 50% bullish, you know, maybe 10 times, maybe 12 times. And when you have really bullish investors, it's actually bad for the market. Why is this? Well, if investors are really bullish, what do? They invest their funds. When they're done investing, the market runs out of buyers. And when the market runs out of buyers, the only way it can go is lower. All right. And this is the same thing on the downside. Like everyone gives Warren Buffett the credit, like, oh, be greedy when people are fearful, be fearful when people are greedy. Well, right now people are greedy, so it's time to be fearful. But people have been saying this since the dawn of the markets, which have probably, I'm sure back in the Roman days or the Greek days or the Phoenician days, there were traders or merchants that knew this stuff. But anyway, when people that you that don't typically invest in the market are like, oh, did you buy this stock? Did you buy that stock? Dude, selling signal. When people that don't buy stocks are buying them, the market runs out of buyers and there's no one else to push the price higher. So let's look at some of these technicals because some of these things are looking pretty weak. So here's the S&P, which we briefly mentioned. The S&P is 11 sectors, and sometimes, well, actually not sometimes, but at all the time, different sectors are in the driver's seat. It could be technology, it could be healthcare, it could be the financials. It changes. Sometimes the market is really easy to read. Sometimes it's about one sector that's going to give you a signal. How does it give you the signal? It gets to resistance and it sells off. It gets to support and rallies. Sometimes the market's kind of complicated to understand. Right now, I would say we're a little bit on the more of the complicated side because I think the S&P is going to bounce when we get down there. But let's take a look. The biggest sector is technology. Technology really gives a good lesson. I mean, I could spend this whole night on technology, and maybe tomorrow, if you want, I'll do just a full lesson on this. But here's our technology sector. This is an ETF that tracks the tech sector. Got to resistance out. Oh, actually, I'm sorry, wrong sector. Well, same story, but wrong sector. I'll get to that in a few minutes. That's consumer discretionary. All right, so check this out. So here's our tech sector. Sector's worth trillions of dollars, but yet somehow we ran into resistance at pretty much the precise level that we were resistance at back here. How does this happen? Psychology. People bought back here. I just saw a show on Bob Ross today and Willie Nelson. So I'm kind of motivated to be kind of chill. Every market tells a story, but if you're Bob Ross, it's a chill story. It's a slow, mellow story. When I was at college at UConn, we didn't have cable. We didn't even have antennas. We had like one channel or two channels, and Bob Ross was on it. As college students do, we turned it into a drinking game. When he had your color, you would drink. I was titanium white or crimson red. And anyway, that's another story. But what happened? We got to a level that was resistance. We hit resistance again. In the market, write this down. In the market, some price levels are more important than others. That's just how it is. And if you can identify these price levels, you can make money because when something gets to one of these price levels, they move. It's like coming to a fork in the trail. You go to you're going down a trail, you get to a fork, you go one way or the other. You don't tend to sit there too long. I mean, look at this. 177 is an important level for this sector for some reason. Gets there, I don't know, there for 2 days, sells off. Gets here, there for 1 day and sells off. Now, what was resistance became support. How does this happen? Seller's remorse. People sold. They want to buy their shares back when the price goes higher, and they tell themselves, I'm only going to do this if I can get them at the same price I sold them at. I mean, look, you don't need to be a chart guru or a former hedge fund trader. And by the way, I'm really kind of sick of this whole, former hedge fund trader, former hedge fund trader, former hedge fund trader. I was the head of trading at 3 different institutional money managers. And under the umbrella of the money manager, we had various hedge funds that had various strategies. So I've overseen the trading at probably, I don't know, 12 or 15 different hedge funds. So I know what I'm talking about. I'm not just some guy you met on the internet. Well, maybe I am, but there's a lot of garbage out there. You know, I've decided that I want to teach at this point in my career. I mean, come on, I'm only 53 years old. I'm going to be 54 in a few weeks. Kind of hard to believe. I mean, I feel like I'm a lot younger. Sometimes when I see people that are my age, I think like, wow, you look older than me. Like, oh, you're the same age as me. Man, do I really look like that? But anyway, God has given me, I don't want to say anything about God, but I just, I have I don't even want to say I have a talent. I have experience. I've been doing this for a long time, and now I want to help people. And I see how much garbage is out there. So I'm kind of motivated. I mean, of course, I want to get paid. Eventually, we're going to start charging for our website, but it's going to be a small fee. I mean, I have a capitalist, but there's so much misinformation out there about what's a hedge fund, what's a market maker, what's an algorithm, what's a dark pool. Just check out our site, stockmarketjobber.com. Check out educational lessons, and you're going to, market lessons, and you're going to learn a lot about all that kind of stuff. All right. Anyway, resistance becomes support. Resistance becomes support. Resistance becomes support. Resistance becomes support. Resistance became support, but now the support is broken. resistance becoming support is a function, I guess. I don't really know what the right word is. A function of seller's remorse. When seller's remorse stops happening, that's a characteristic of a market top. So we got to resistance. It was support for a while, but now the support is broken. This is a characteristic of a market top. So, I'm not saying the market's going to crash. I mean, I don't think it's going to crash unless stuff out over in Ukraine gets out of control. If that happens, then the market could crash, and rightfully so. But anyway, I mean, it's such a disaster over there, and it's like, geez, are we just like throwing them untold billions of dollars because they bribe Biden to get new policies, and you know what? Yeah, I think there's a really good chance that that happened. Okay, so whatever you want to argue about politics, send me an email. I'm ready to go. All right, and I'm an independent. I'm not like a hardcore Republican. I mean, I think George Bush Jr. was a terrible president because he brought us to war. I think um, Obama was a terrible president because he could have fixed healthcare, but he sold out to the insurance companies. I think um, Trump was a good president because his policies were great. I think the guy we got now is an absolute disgrace, and I think he's going to be out of there soon. But anyway, we'll deal with that when we get to it. It'll probably cause some uncertainty in the market, and then hey, we can make money when there's uncertainty. Markets move, and that's how we can make money. I mean, look, man, I'm only one guy here in my silo in Connecticut. I'm not going to get too upset about it. I don't really care. I mean, I do care because I'm a proud American, but whatever, things will turn. Whatever, whatever. Anyway, so this is our healthcare sector. Also important to watch are the financials. The financials I've been talking about, like what's in the driver's seat. Financials have been in the driver's seat for the last couple of weeks, and this is why the market's gone lower. We got to a level that was support. It became resistance. What happens is the market's going higher because there's not enough sellers, and buyers got to pay up. There's not enough demand. I mean, sorry, there's not enough supply to fill the demand, so buyers have to pay higher prices. A lot of the sellers start thinking, "Oh, look, I want to sell, but the market's not moving higher anymore. There must be new sellers coming into the market." And some of these sellers start to get worried and they think like, "Oh, gee, you know, if there's new sellers coming around, I'm going to get worried because the buyers are going to go to whoever is willing to sell at the lowest price. So if someone else is willing to sell at a lower price than me, the buyers are going to go to them. So these sellers start undercutting each other, and you get this snowball effect. It has nothing to do with the debt ceiling or whatever they're talking about now, Fitch. Psychology. Markets get to resistance. They sell off because you have anxious sellers undercutting each other. The opposite is true when you get to support. You have buyers who are afraid the sellers are going to go to someone who's willing to pay a higher price. So they increase their prices. So markets get to support and they rally because of anxious buyers. Markets move 95% of the time because of psychology. It's not because of the news they're telling you. And when you get to these important price levels, that's where you can make money as a trader. Because when we get to an important price level, we break one way or the other. Look at this. We got to support, we rally. We get to support, we rally. Resistance, sell off. Resistance, sell off. Resistance, sell off. Yeah, I don't want to say it's easy, but if you understand how important it is to understand which price levels are important, you're not going to be like guessing and just kind of putting your head in the sand, not knowing what to do. All right, everybody. Thank you so much. I am going to go now, and I will talk to you soon. And I hope to see you. Please check out our website, stockmarketjobber.com. And thanks, everybody. Have a good night.